Profit is not just a number, but a story that starts at revenue, passes through the costs of making your products, and survives the grind of operations and taxes. In Fortune 500 boardrooms, the story is read from top to bottom, like a waterfall. At the top is a massive rush of water, representing revenue or total sales. As the water falls, it hits several rocks and ledges, splashing some water away at each level. By the time it reaches the bottom pool, there is much less water than at the top. This pool at the bottom is the net profit. Many businesses fail not because they don't have enough sales revenue, but because they lose too much of the revenue in costs. In this lesson, we will build a profit and loss waterfall for Greenleaf Bakery. We won't just calculate how much money we made, but we'll also analyze where the money went. This is the difference between a bookkeeper who records history and a financial analyst who shapes the future of businesses. The core concepts. In the Fortune 500 world, executives analyze profit in 3 distinct stages. Each stage tells a different story about the health of the business. A. Gross profit. This is the money left over after paying for the direct costs of making your product. It is known as the efficiency metric. That is money left after paying for direct materials and direct labor costs. In the retail business, it is the markup on the sale of products purchased. The formula is revenue minus cost of goods sold, COGS. It is a business's measure of efficiency because it asks the question, are you sourcing materials and producing at competitive unit costs? In retail businesses, the question is, are you sourcing products at competitive prices? Also, are your prices optimal enough and relative to variable costs? And are high-margin products getting the volume they deserve? Now, the first question looks at your negotiation power when sourcing for materials and labor. If these variables are high compared to the industry standard, your gross margin will be low. For example, in the retail business, if a product is sold for $200, your ability to source it at the lowest possible price increases your gross margin. The second question looks at your pricing strategy. Because price defines profit, your prices should be optimal enough to cover all your variable costs. The third question looks at your positioning strategy. High-margin products make your business more profitable than others. Thus, it should be strategically positioned to attract more sales. In general, if gross profit is low, it means that your products are too expensive to make, or your prices are too low, or your high-margin products are not receiving enough sales volume. Note this, no amount of cost-cutting and operational expenses can fix a gross profit problem. Gross profit tells us whether our core business model is working or not. B. Net profit. This is the final profit after all expenses have been paid, including operating expenses, OPEX like rent, salaries, marketing, and utilities, including interests and taxes. The formula is gross profit minus total operating expenses minus interest minus taxes. Net profit measures the overall profitability and sustainability of a business by reflecting operational efficiency, capital structure, and tax strategy. Operational efficiency assesses how well a business controls and scales its expenses relative to revenue. Capital structure reveals the cost of financing, where businesses relying heavily on debt may see reduced net profit due to interest expenses. Tax strategy impacts net profit through the effective tax rate applied to earnings. In general, net profit tells the story of the viability of the entire business by answering the critical question, is the entire business financially viable? A company can have a great product with high gross profit margins, but still face financial distress if overhead and other expenses are not managed effectively. Net profit provides a comprehensive view of a company's true financial health and long-term sustainability. C. Profit margin. Margins are the language of business executives used to measure profitability. They are ratios used to compare performance across products, months, years, and businesses in the same sector. Profit margin is actually a ratio that converts profit numbers into percentages. It therefore tells us how much of a business profit is kept from every unit of sales made. The formula is profit divided by revenue times 100. For example, if Greenleaf Bakery has a 15% net margin, it means that for every 1,000 sold, the owner keeps 150. This percentage allows benchmarking against large companies like Starbucks and local competitors, regardless of size. There are different types of profit margins, including gross profit margin and net profit margin. They are calculated as follows. Gross margin percent equals revenue minus cost of sales divided by revenue. Net margin percent equals net profit divided by revenue. Margin is an excellent indicator for comparing the efficiency of businesses. It can help us to answer the question, how efficient are we compared to the competition? It also highlights where to act and exercise control over a business by helping us to decide whether to raise prices, reduce variable costs, or cut overhead. The above concepts help you build a solid foundation that you can apply to any business. Next, you'll use these ideas to create a profit and loss statement template in the upcoming lesson. Stay tuned for more valuable insights in the next lesson. Subscribe, like, and share.